Welcome back, folks, to Investor Diaries. Today, we're going to talk about how a start a portfolio or how do you go about starting your investing journey. So, we got a lot of feedback about what are the different techniques for portfolio consideration, what are different considerations I need to have, or how do I get started about investing. Or I have seen a tremendous retail growth in the or tremendous growth in the retail space in the last year. How do I participate in the market? So we'll try to tackle some of these questions and some of the tips or considerations that you need to keep in mind while you go through the portfolio construction phase.
So one thing that you need to think about is, where do you want to invest? Now, this is a really important question because it kind of depends on which stage of life you are in, what's the money that you're making every single year. So we decided to speak about these two major accounts. We'll speak about two. One is an RRSP, which is a registered retirement savings plan. The other is a tax-free savings account, which is TFSA. Now, RRSP is interesting. If you think that your income is substantially going to increase over a period of time, then in that case, you should consider RRSP right now. So the way it works is that any money that you contribute towards the RRSP is tax sheltered. So for example, if you make $70,000 a year and then you decide to contribute $10,000 that year towards your RRSP account, then you only pay tax on 70,000 minus 10,000, which is $60,000, because that amount of $10,000 that you invested in your RRSP is actually tax sheltered. An interesting point to note here is that any gains that you make on that $10,000, let's say you get some dividends or you have some capital appreciation, is not taxed as well. So you stand to gain a lot over the next few years. Of course, if you decided to withdraw your money from RRSP at any given point of time, then it kind of becomes taxable. However, it's kind of assumed, or the way to go about it is, people think that you will use this money while you are retired, and that's why the name retirement is there in the terminology. At that point of time, you'll be making less money, your tax bracket will be low, and that's why you can enjoy the gains of lower tax. The second one that we want to talk about is TFSA, which is tax-free savings account. Every year, the government of Canada allocates $5,000 to $6,000 towards TFSA. Now, it's different to RRSP, which means that the money that you allocate in TFSA is taxed at the source. So that $5,000 is not tax-free. Instead, what's happening is that the gains you make on this 5,000 becomes tax-free. So as an example, if you decided to say buy Apple stocks at $100 and Apple stocks went to $200, then you have 100% gain and you gained $100 as a result of it. At any given point of time, if you decided to withdraw money from your TFSA account, this will not be taxed at all. And that's the beauty of TFSA. So our recommendation at Investor Diaries is that you should max out your TFSA every single year or when you have an opportunity to do so.
Right, and those are great points. So I just want to call out there as well. Like, yeah, our recommendation is you first tap out or max out your TFSA, but if you also if you have substantially high earning this year and you don't anticipate your income to go up higher, then you may consider putting some money towards RRSP as well, just to save advantage or get advantage of that tax deferral. So keep in mind, RRSP is tax deferring, and TFSA, as Appy mentioned, is your tax money or the post-tax money that you're investing, but the gains on the money that you invest in TFSA is tax-free. And again, another call out here is like RSP and TFSA are different investment vehicles here in Canada. And depending on the country that you're viewing from, your country may have different tax advantaged accounts. Like for example, in USA, it would be your Roth IRA accounts or your 401 savings plan, which works on a similar concepts. But essentially, the key point is you want to avoid paying tax on the appreciation on your investments or the dividends on your investment, right? So, and that's why it makes sense to use tax advantage vehicles that you have available in your country. Of course, once you max out these vehicles, then you always have the option to go invest in a regular margin account, right? Now, the other question a lot of folks ask is, when do I start investing? When should I start investing? Should I wait till I'm 30? Should I wait till I'm 40? Now, the simplest answer to this is the best time to start investing was yesterday. So, if you haven't started your journey, start today, because if you start early, you take advantage of the power of compounding. So, what is the power of compounding? Now, let's say you have $100 today to invest. You invest $100 and you continue investing $100 a month for the all of 2021. So, end of 2021, you have invested $1,200. Assume the money grows with a 10% annual income. The growth gets reinvested and you get returns on the growth as well, right? So that is the concept of compounding. And typically, if you're garnering 10% annual return, you can pretty much double your money in 7 years. So that's pretty much the rule. If your growth rate is higher than 10%, then you're doubling the money faster, right? So that's why all investment pundits out there would recommend you to start early and start small too. Even if you don't have to wait till you have, let's say, amass $1,000 to invest. No, even if it's $10, even if it's $100, start investing today. Whatever you can, start small, but start today.
Yeah, the power of compounding is huge, and sometimes we tend to ignore. So
Yeah.
think about those small dividends that you get. It really adds up in the long term. The next one is on risk bearing capacity. Now, where you decide to invest depends on a lot of factors, such as what's your age, what's your risk bearing appetite, what are you comfortable with in terms of growth or even dips. So, as Nidish mentioned, 10%. Now, 10% is a fairly standard rate of growth. It's neither very high nor very low. But remember, when you invest, your investments can actually go down. And we don't have to go far back. Like last year during the pandemic, we all saw that most of the equities went to an all-time low, and that was when a lot of people started panicking, they started selling. So you have to be comfortable with this situation as far as, say, investing is concerned. So really think through what you are comfortable with, what you are not. And this brings me to my next point. When when a stock or an equity or a financial instrument dips in value, it means that if you decided to withdraw money at that point of time, you would have less money than when you started investing. So you should think through when you need liquidity. Do you anticipate that you need to buy a house and that's why you need to have money at that point of time? Or is your time horizon, say, 10, 12, 15, 20 years, in which case you can probably go for more risky investments. However, having said that, if you need money in the immediate future, our recommendation is that you should go for more conservative portfolios, maybe something which is more dominant in bonds. Whereas if your time horizon is large or huge, then you can think about going for more aggressive portfolios.
Yeah, yeah, great points. And one other thing I'd add there is that keep an emergency fund. So what do I mean by emergency fund is uh, keep some money parked away for 6 months of your expenses. So maybe have a rough calculation about what your monthly expense is going to be, multiply that by six, and then keep some fund away just in case. Something happens to your earning potential or with your job, you still have a fund parked away to tap into when you need money. And the money that you're not in your emergency fund, you can invest it and try and hope to grow and then garner returns on those, right? So we had covered some of the basics. Now, in the subsequent video, we could talk about what are the different ways to construct your portfolio based on your risk appetite, and we can also talk about what are the sample starter portfolios that you can consider taking away and consider chipping away and starting to invest, and then start your journey. So um, stay tuned for our upcoming videos on this investor basics series, and hopefully these videos help you and starting your or kicking off your investing journey. And then start your journey. So um, stay tuned for our upcoming videos on this investor basics series, and hopefully these videos help you and starting your or kicking off your investing journey.
Thank you so much.